what I do know in all markets is that the final leg, the Elliott wave guys would call it the third leg up.
Yeah.
It's usually double the second one. So the second leg up in silver was from around $9 to $50. So that was about a five-fold increase. So if you double five, that's 10. So you go from the bottom this time, which was roughly 12 during the CV19 situation in March 2020. And it was a spike 12. I don't count it, but I'll use it as the low. So 12 times 10 is 120.
Renowned precious metals analyst David Morgan is preparing for the last leg of a precious metals run-up, which he says is going to see the price of silver go from just above $24 to over $120 per ounce. According to Morgan, the chief editor of the Morgan Report, the coming leg up will dwarf the rallies of the past years in significance and intensity. On the homepage of his website, Morgan optimistically states, "Believe me when I say this, the most significant money is yet to come." In a recent discussion with Daniella Cambone of Stansberry Research, Morgan references CPM Group Managing Director Jeff Christian, stating that 90% of the upside moves in silver come 10% of the time. Morgan explains that the statement simply means the big moves in silver come during a brief window, which can easily be missed by investors who are not patient enough to hold on to their precious metals during less than exciting market conditions. During his discussion with Cambone, Morgan also discusses the misconception about buying when prices are perceived to be high. According to the renowned economist and financial commentator, you can still make a lot of gains on your investment when you buy at certain price levels, even when they are way higher than previous lows. This is because the run-up from those perceived highs will be exponential and more rewarding than previous rallies. This highly optimistic outlook is Morgan's approach to precious metals, especially gold and silver, in 2023. We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Yeah, actually, I have to give credit to Jeff Christian. Jeff said it years and years ago, and of course my ears perked up, and he said 90% of the move comes in the last 10% of the time in the silver market. And that caught my attention. Of course, I knew what he was talking about, so I went home and I did the arithmetic.
Yeah.
And I found out that, during the Hunt situation in the late 70s, 1980, that if you were a patient investor and you bought silver in 1965 when it was taken out of circulation at $1.29 an ounce, and you waited until January 1979, you'd hit an all-time high of $6 an ounce. But if you were a rank speculator, you didn't know any better, you got in at $6 an ounce in January 79. You waited 1 year. It went from $6 to $50. So you had over an 800% increase in 1 year. So if you do the arithmetic, what you find out is that move from 6 to 50 is about 90% of the move. And if you look at it from 1965 to 1980, it was in about 7% of the time. So the rough numbers. Now, just because that's what happened in the past doesn't guarantee it'll happen in the future. But what I do know in all markets is that the final leg, the Elliott wave guys would call it the third leg up.
Yeah.
It's usually double the second one. Now, I've said back in 2003 in my first book that silver would be $100 an ounce, roughly speaking. I do expect triple-digit silver, and I still do. So the point, coming back, we want to reemphasize it, Danny, and that's that all markets get this big rush at the final run-up. It goes parabolic, and people just are fearful of missing out, and so they're paying high and higher and higher and highest until you run out of buyers, and then you get a sharp decline right away. I do think that's going to happen in the metals again, unless they are brought into the monetary system some way, but they're more diversified, especially silver, because there's more hands worldwide, and it's small hands, retail investors. So it's possible that might mitigate a sharp correction.
Right. Well, let me ask you this, David. What are signs that we're in the last leg, and how do you get, ahead of that?
Well, technically, you would have to wait and just be patient and wait for gold to break the all-time high, which is, I don't know the exact number, 2,067 or something like that. It would have to maintain that above that price for at least 3 days in a row. That's the Morgan rule. And then if it does do that on bigger than average volume, then you have about an 85% probability you're on your way. So now in the commodities markets, as you probably heard others tell you or talk about, old resistance becomes new support. So we have a resistance around 2000. Once it breaks through to the new high and it settles above that, then that becomes support. So it's not going to go below 2000 without a lot of work. So it's going to go from 2000. And what most people don't know, and I learned this from Bill O'Neill when I took a course at Investors Business Daily from the master himself. Bill actually taught the course. As the reason you actually want to buy on a new high when it first starts as a new high is because if a stock goes from $5 to $50, how many new highs does it make? And the answer is a heck of a lot, because when it goes, at 5 and it makes a new high at 6, everyone that owns it at 6 says, you know what, I'm making money, but I don't know how high is high. I'm going to hold on. So everyone's holding, so any new buying pushes the price up to 8. And now those people that owned it at 5 say, he's $8, that's a pretty good profit, but how high is it going to go? I'm going to hold. So any new buying takes it up to 10. And on it goes until it exhausts. It's like throwing a ball into the air. It'll keep going up, but eventually it will hit equilibrium and start coming down. But there's nothing safer than actually buying at a new high, as long as you know where the new high starts and then just follow it up with a stop. I mean, I did quite well in the run-up in silver in April, May 2011. And I called the top. I called the top for my subscribers, and then I said it publicly. And, looking back with 2020 hindsight, I probably should have just bypassed the market for 10 years and come back in. But I didn't know the future, and I'm still a sound money advocate.
Earlier in the month, the Wall Street Journal published an article titled, "Is the Banking Crisis Over? We Are About to Find Out." The article identified 3 concerns that could determine if the banking industry is out of the crisis or about to enter into another more severe phase. The concerns are increased deposit costs and reduced deposits, bond losses due to rising interest rates, and the elephant in the room, commercial real estate loans. According to the WSJ, many mid-sized financial institutions with a heavy concentration of commercial real estate loans in their portfolios could be impacted by the low occupancy rates in commercial real estate. During the interview with Cambone, Morgan weighs in on the possibility of another banking sector crisis in the United States and how depositors can protect their wealth.
Be fair, I think Weiss Research does probably one of the best jobs for rating banks in the U.S. I think you have to pay for the report. But you want to find a sound bank, and a sound bank could be in your own community. I mean, if I want to digress for just a moment, Daniella, but up until the Clinton administration, we had what was called the Glass-Steagall Act in the 30s under the Depression. And that, in my view, was, and I'm free market. I'm not for a bunch of regulation, but Glass-Steagall made a lot of sense. There are 2 types of banks. There were investment banks, and there were what I'll call merchant banks. Merchant banks are based on the physical economy. Farmers, construction, car dealers or whatever, where actual physical economy took place. Investment banks were like your Goldman Sachs, where if you wanted to gamble on a new stock offering or some type of structured bond or whatever, well, then you went to investment banks, but they're separate. So the merchant banks were pretty much sound across the board, whereas investment banks are more speculative. You might make a lot or you might lose everything or somewhere in between. Well, that got taken away under the Clinton administration. He let them merge, and every bank became an investment bank, basically. So the risk level went up exponentially from that time forward, and it keeps going on and on because we keep piling on more debt and more misallocation of capital. So my point is that those assets have to be brought to reality, which means mark to market at some point. So when the people that have a bank account that's basically yielding nothing see there's a money market yielding 4.5%, they move their money out of the bank and into the money market, which means the bank's assets, which will be, let's say, long-term bonds, have to mark to market to make that cash withdrawal. And to make that cash withdrawal, they sell them at 20% discount, because that's the market. Mm-hmm. The market says that 1% yield has to get back up to a 5% yield. And to do that, you've got to discount it by 20%. So as that happens, that depletes the asset side on the balance sheet of the bank. And now they become insolvent or can become insolvent. So it's far from over. The more and more banks are insolvent. And then there's, of course, the systemic risk because all banks are interconnected. And so one bank might have a swap with another bank or some kind of financial instrument that depends upon interest rates or whatever. So it could, cause the domino effect where one bank looks good today but it's not good tomorrow.
Right.
Or it could be run on a bank, which really was Silicon Valley Bank, where a very prominent, well-known individual in the tech space said, you should get your money out of the bank. And he whispered it to some of his whale friends, and they started pulling their money out. And all of a sudden, bam, Silicon Valley Bank is like underwater. So it's far from over. I don't want to scare anybody. I think as long as you have less 250,000 or less in the U.S., you're probably okay. I think that the FDIC, even though they don't have the money, I think the Fed will print it up and make you whole. Don't worry too much. If you're above and beyond that, you might want to think about mitigating the issue with buying, getting into an asset class or, making some move that would protect you. Because if this thing falls rapidly, then it's very difficult to mitigate the problem.
Morgan believes the last leg of the precious metals run-up will be the largest yet, possibly propelling silver into the revered three figures and gold past its current all-time highs. This is why it's important to keep stacking, even at current prices, so you don't miss that 10% window that can give you 90% gains. Please share your thoughts on Morgan's silver predictions in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.